We're watching a crash in motion. Maybe you haven't heard, but Chinese real estate ain't doing so hot. It's already playing out for China, but if it spreads, you could see it come here. So if it does hit the US, you can see a similar type of contagion. And these are the signs that you need to look for. The other thing that's playing out with us is an inflation narrative that could make this a really, really nasty powder keg. Certain conditions help you think about what a crash could be like, right? But the problem is you need something to kick it over the edge. Something, if you were on the side of Mount Everest, to kick you off of it. So you need to separate the conditions of a crash versus the catalyst, right? The conditions for a crash include, and on a qualitative FAA basis, right? We're not talking about a quant kind of thing. We had already pointed out hype, easy credit, and leverage. There's one more that really helps, right? Because the way you need to understand the economy is that one man's spending is another person's income. So if you remove credit, you get very sharp reversions. You add on that into the dog shit fucking pile, leverage, and you add mania on it, which is hype and speculation, and you get an epic perfect storm of swimming open mouth in a sewer. Let's just give you a little hint. You don't want to do that. Inflation is a condition. It's not what I was thinking of, but inflation really does help a crash happen. Not at first. Okay, this one, according to several papers that I was looking at the other day, it's about a 12 to 24 month lag of a negative correlation with SPY. So yeah, it does help. Defaults help. Okay, so for me, worsening credit quality, which means I don't think they're going to pay back as much, right? That's different. Right? That's coming up to it. So what are some catalysts? What happens? Have you ever seen in a stock when everyone realizes that it's kind of like a scam, most likely? The rug pull. Yeah, that's exactly it. That's a way to talk about it. Yeah. The academic version is the Minsky moment. It's a capitulation. Yes, exactly. Perfect. See? This is the problem with finance. It's not rocket science, guys. Okay? What the financial industry wants you to think is that you need them to explain complicated things to you that you already know. You just don't know the words for it, right? Confidence, right? Confidence is very important. It's necessary to trade with someone else, right? Because somebody has to be on the other side of the trade. If you're buying something, somebody has to sell it to you. If you're buying insurance, somebody has to insure it to you. That's a market, right? It's essentially an auction system where people are bidding and asking for a price, right? You guys see every day, you see a bid and an ask. So there always has to be what the word is called a counterparty, right? Somebody else on the other side of the trade. They absolutely change the words to confuse you. If you've ever watched, if you like to study history, which I suggest that you do, especially when you're talking about crashes, because they happen again and again, over and over again, is that if you watched the Japanese central bank, there's a movie called The Princes of the Yen. And the central bankers literally admit on this movie that they use complicated language to confuse people, to communicate things that they wanted to do just solely so they could do them. And that was part of their strategy. The rug pull is definitely one. Thank you very much, Strat. Confidence Minsky moment. There's one more that I do want to touch on, and there's lots of them, but there's three that I want to touch on. Okay, so the last one is liquidity. Okay, the number one thing, has anyone in here operated a small business maybe? Maybe you've operated, I don't know, maybe you flip stuff on Craigslist. That would account, right? And one thing that's so important that you guys may not understand when it comes to businesses is liquidity, right? And this is kind of a general term. What it really means is a company has to be able to produce cash flow to be able to operate, right? So let's take a bank, for example. What's happening right now? We have repos that are coming up. There's a fucking gnat flying around. For example, they need cash provided by somebody else, by a counterparty for their assets to be able to have cash to operate or to lend out or to what? Have reserve requirements, right? They have to have a certain amount of cash for the loans and for the savings accounts that are on their books. It's the same thing with small business. You have to, if you're a widget maker, you have to have enough cash to buy the widgets before you turn, or the supplies for the widgets before you put them together. And the inexorable fact that you need to understand about this world is that everything runs on credit. When your employer pays you on payroll, that's on credit. When they pay vendors, they pay it on credit. They typically have a 30 to 90 day, payment terms, right? The credit provider, right? Like you guys have FICO, they have Dun & Bradstreet. Everything in the world runs on credit. Everyone is leveraged to the hilt. Everyone has a creditor. And what's so important is the roll, is what it's called. It's, can they produce cash to pay things when credit is not available? So if nobody can provide liquidity for you, it could be a crash catalyst. It is exactly that effect. It's a chain that works because they roll or they refinance their debt into something else, right? If no one is able to provide you that liquidity, then you're essentially insolvent, right? That's a crash, is the specter of insolvency becoming real. So if we look at a lot of reports, they determine liquidity by looking at spreads. So that's the difference between the bid and the ask. So you can look at any ticker and see its bid ask. For example, Tesla is 1047 by 1047.69, right? So it's a 50-cent liquidity, aka having a counterparty that's willing to give you a market price on both sides, okay? Right, so what we're going to do is we're watching a crash in motion, okay? So the Chinese real estate and Chinese developers are literally going through a crash right now, right? And we're gonna look at a couple of things that you can look at. If you live under a rock, maybe you haven't heard, but Chinese real estate ain't doing so hot, okay? So we had 37% reduction in sales reported about a week or two ago. Now, what you need to understand about China is they use real estate like a savings account. They use it like their retirement depends on it, right? So most of us in the United States, we use the stock market, right? We've got that in a combination with a 60-40 bond and stock split, right? And yeah, maybe we have our personal home, and yeah, maybe you diversified and you've gone to real estate, but the majority of our wealth is stuck in the stock market. Actually, bonds. Let me say the right thing. Bonds. So, but for them, that and wealth management products is the majority of where they are, if you can believe the Chinese numbers, okay? So what has this done to their economy? Well, it's made the living standards really tough, right? So if you look at the average income of somebody here in the United States, New York and California are about 10 and 8 times the average income to purchase a home in that area. So let's say we have somebody with a $50,000 income. That means the average home is $500,000. In China, the magnitude is more like 20 to 30 times. So that same person that is making $50,000 is looking at having $1 million, $1.5 million, 2 million in some of the more expensive cities. So what that means is, I don't know the ratio for Canada, but what that means is, yes, it means Squid Games. Yeah. It means that it's really difficult for people to acquire real estate in China and in Asia. Really, Asia is way more expensive on real estate than we have it. If that thing crashes and that's their retirement plan, it means totally different things for them versus us. So the things that I'm starting to notice are concerning because today we had an article out by Bloomberg, and I'm just going to read it to you, right? And keep in mind the things that we taught you to look for when you're thinking about a crash, right? China's property developers are struggling to pay bills that many of their bond investors didn't know were there in the first place. And we're going to teach you about off-balance sheet debt, which is what they're referring to. But the important thing is what you're seeing is that China's junk bond yields are going up, right? That's a significant indicator of problems. So I'm going to read this paragraph to you, and you tell me what catalyst we're talking about. A lot of these companies have a lot of private credit, said Philip C., and head of Hong Kong and China property research. It's very hard to say who is safe now anymore because the whole market has lost its refinancing capacity. What is that? It starts with a C. Crisis of confidence with a counterparty. If you're literally looking at the entire market and you don't know who you can trade with because you don't know who can be solvent tomorrow, that's a crash. You're already in it. If they won't trade with each other, that means that nobody will allow them to get new money to build new homes, to refinance. Now, what's really weird about Chinese real estate companies is that they're also quasi-banks, right? They have these things called management products or private wealth management products. So people are losing their savings as well. But another condition of a crash is off-balance sheet debt. This was especially prevalent with Enron, Lehman Brothers, and a lot of the banks during 2008, right? What this means is, so FASB, which is the Fair Accounting Standards Board, with Rule 7B states that if an entity's debts don't make a majority of it, that they can house it in an entity that is not on the balance sheet of that company. So it's kind of like if you had a bookie that you owed money to, but you look at your bank account and your entire balance sheet and you don't tell the guy that's lending you money that you really owe, $200,000 because you were YOLOing some weeklies on DWAC the other day and you're the asshole who bought it 100. So to me, this is really concerning that we're seeing that. The other thing is, if you want to look at some of these things play out real time, is you can go to world bonds. Now, this is sovereign debt, but you can see their credit default swaps and their spreads. And so then they grade them, which is, the ratings companies go out there and grade them, but you can also see the CDSs. You can also see the yield curves of it. Russia and Brazil inverted? No way. That's really concerning because Brazil is one of their top trading partners. China's Brazil. Brazil supplies them a lot with their resources. So Czech is inverted, Russia and Brazil. Let's just look at the tweets because they've pointed this out. Unfortunately, with bonds, it's kind of like you need a better tool to look at them. Okay, so here, these are the Bloomberg reporters for China. So I've been watching them. Higher rated dollar bonds suffer worst slump in months. So they're starting to adjust not only the dollar bonds of the individual companies, but they're spreading to investment grade bonds. China's higher quality dollar bonds are suffering their worst sell-off in about 7 months as property woes spill into the broader credit market. Spreads on the investment grade notes, which account for the bulk of offshore dollar securities from Chinese issuers, widen about 8 to 10 basis points. That would be the biggest daily expansion since April after a widening of 7 basis points Monday. So what started this whole thing? What did we say were catalysts? We said regulation was catalyst, right? So in China, as part of, it's called the dual circulation. It's their new strategy for common prosperity, where they want to change China from a export-driven economy, where they export a lot of stuff to us, and to a lot of other developed nations, to a consumption-based economy where they want income equality, right? So as part of that, they wanted Chinese developers to reduce their leverage ratio. It's called the 3 red lines. They did this in, I think it was April. And now we're seeing the result of it. And now the Federal Reserve has decided to weigh in, and that it could become, in their annual report, they're saying it could become a problem for us. So let's go to the actual report and see what they've said. In addition, stresses in the real estate sector in China, caused in part by China's ongoing regulatory focus on leveraged institutions, as well as sharp tightening of global financial conditions, especially in highly indebted emerging market economies, could pose some risk to the U.S. financial system. If realized, the effects of near-term risk could be amplified through the financial vulnerabilities identified in this report. First, now they want to blame retail traders. The second, the role of foreign investors in the March 2020 turmoil in the U.S. Treasury market. So we're going to go to that. And what did I talk about is the number one thing that's a catalyst for you to see a crash in something is the refinance of the debt, right? What does the Federal Reserve do every day? It refinances its own debt by rolling treasuries from one expiration, so to speak, to another, right? Because once a treasury matures or needs to be paid on its value, then somebody has to go buy this new debt, right? So what they're talking about is that in March 2020, this became a market where people didn't want to buy our debt. The U.S. Treasury market is critical to the overall functioning of the financial system and to the effective transmission of monetary policy to the broader economy, blah, blah, blah. They are the most liquid securities in the world and play critical roles as safe investments, collateral for secured credit, and pricing benchmarks for dollar loans and fixed income securities. In March 2020, as the effects of the COVID-19 pandemic on financial markets intensified, the U.S. Treasury market experienced severe dislocations, and market functioning became unusually strained. Although many different types of market participants contributed to the sell-off of U.S. Treasury securities, this discussion focuses on the important role of foreign investors. Okay, so who has to refinance the U.S. debt? It's foreign investors. They hold $7.2 trillion of our debt. Here's the kicker. To understand whether foreign domiciled funds did indeed sell U.S. Treasury securities in response to outflows, we analyze blah, blah, blah. The results show that fund asset sales were not proportional to holdings at the beginning of the month. Rather, outflows led to greater net sales. So they did actually sell off on a net basis. So we saw some actions in play that are happening right now that could play into a crash thesis. It's already playing out for China, but if it spreads, you could see it come here. Now, that would be a big deal to really predict, treasury bonds crashing, because it would just be sheer fucking pandemonium. But even if it doesn't hit US treasuries like on a real basis, you can see what's happening in China, right? It stays with the property developers, then it goes to investment grade credit somewhere else, like Tencent, Alibaba, right? So if it does hit the US, you can see a similar type of contagion. And these are the signs that you need to look for, right? The other thing that's playing out with us is an inflation narrative that could make this really nasty, a really, really nasty powder keg. So I live in a landing. It's kind of like short-term housing, right? So they're basically, the way you need to think about them is they're corporate apartments. So somebody else pays the 18-month lease, and then I just pay them for the month. They furnish it for me. They put everything in the kitchen, whatever. They pay for utilities, and I just pay them a flat fee, right? So the way they make money is they make money on the spread between the rent and how much I pay, right? So I saw a letter. The rent for this apartment, it's a 2-bedroom, 2-bath in Dallas. And this is what the corporate apartments people pay, right? It was $1,400 for a 2-bedroom, 2-bath in Dallas for 18 months ago. That was the amount that they wanted. Today they have a renewal letter, and let me just show you it. $24.94 per month. The 18-month rate, the 1-year month rate is $2,800. The 18-month rate is $24.94. I pay $3,000 for this apartment with the utilities, everything else. That means those people, if they accept they have to accept the 18-month rate for them to make any money. We're fucked. When PCE comes out, which is personal consumption and expenses, and we understand that owner's equivalent rent, which is basically the stupid version of how they measure inflation, right? They go out there and they ask owners, they survey owners of homes, what market rent would you charge, right? Well, guess what? It's not a market price, right? What is that increase? That's a 78% increase. In Dallas, Texas, 78%. No, that's the rent that the corporate people get charged, but it gives you an indication of how much businesses are getting squeezed, right? And this makes sense. The intermediate producer price inflation, which is the inflation that it's the inflation that intermediate goods providers experience. So a corporate housing provider is an intermediate goods provider, right? Because they buy space in an apartment and then they sell it to a person to do corporate housing, right? That's an intermediate goods kind of reflection. And it's 24% right now. Tomorrow we get the new CPI print, so we get to see what inflation will be. So this mixed with the inflation powder keg, I think is going to be really nasty, and why I'm full tin hat mode. Full tin hat mode. That's wild. I don't know what to say. Just watch that CPI print tomorrow. I mean, I like that you point out that you can find cheaper. So what's funny with how we measure inflation is if you change where you live because it was too expensive, right? Then inflation actually didn't go up. But see, that's kind of like an academic version of it because your quality of living actually went down, right? The CPI is calculated with a substitution method, right? So let's say you have filet mignon and steak, right? If they both go up by 10%, but you change your habits because, regular steak versus filet is less money, even though they both went up, your inflation rate is 0. the substitution inside the CPI is like a fugazi for me. So if you have filet mignon and you have steak, right? Let's say filet mignon is $13 a pound and steak is $10 a pound. Let's say they both go up by 10%. If they both go up 10%, but you switch your behavior from filet mignon to steak, right? You would think that the inflation rate is still 10% because everything went up by 10%. But because you changed your behavior because you wanted to get steak because it's $11 a pound and now you can't afford it as nicely, the inflation rate is actually 0. But you received a noticeably different quality of living. Let that little simmer and fucking sit in there, right? But your quality of living went down. CPI and PPI aren't correlated. They lag each other. So PPI is considered predictive of CPI. So PPI is up at 8, I think, right now. So the year over year, the final demand index rose 8.6% for the 12 months ended in October. What's a leading indicator of PPI is intermediate producer price inflation. So if I can find that shit. Processed goods for intermediate demand. The index for processed goods for intermediate demand advanced 2% in October, which is the month over month date. For the 12 months ended in October, the index for processed goods for intermediate demand advanced 25.4%, the largest 12-month increase since jumping 26% in January 1975. And the Federal Reserve says that they're going to let this shit run hot till the third quarter of 2022. Where are we going to be? Where are we going to be at that point? Like, oh, all these acronyms? Yeah, unfortunately, it's the only really way to communicate these things. I mean, I tried to explain them as best as I can, Joan. But well, thank you for coming to my TED Talk. This is the powder keg that I think is headed for us. There are several other things that are worrying me. For example, our margin debt levels are this more than they've ever been. What is a margin debt level? It's how far people are extended in brokerage accounts. We have the biggest economic fiscal cliff or the biggest benefits cliff coming, even though people think that unemployment benefits were rolled back, which they were. I think there's 27 states that still have stimulus programs running, and they end in December. I wonder why they did that, because they want you to have a good Christmas and not think about this shit. We're seeing energy providers all over the world go bust because energy prices are out of whack, right? If you look at 2008, the number one thing that went before 2008 was the price of oil. We have a significant reduction in credit quality. 1/4 of all installment loans in the United States are going delinquent, right? So what is an installment loan? That's buy now, pay later shit. Have you ever seen that? The Afterpay, the Affirm shit, right? The layaway shit. The debt limit showdown is going to be in December as well. So yeah, so after Christmas. But thank you for coming to my TED Talk. I hope you enjoyed the doom porn. I'm set up for this shit happening. Hopefully you guys choose to limit your risk a little bit as you decide to enthrall yourself with the dog shit that is out there. I don't tell you not to trade. I just want you to understand the risks.